Welcome back to Value Vault, everyone. Today we're diving into a debate that's been heating up in financial circles. Can Bitcoin truly stand alongside gold as a reliable store of value? For centuries, gold has been the undisputed king, but this digital challenger, Bitcoin, has certainly made a strong case. Anna, let's start with you. What's your initial take on this comparison?
Thanks, Costas. Honestly, I think it's not even a comparison anymore, it's more like a succession. Gold had its time, and it was great, but Bitcoin is just better suited for the modern age. It's digital, it's global, it's deflationary by design. The world is changing, and so should our primary store of value.
Whoa, succession? Anna, hold your horses. Gold has literally thousands of years of history behind it. Civilizations have risen and fallen, and gold has always been there, holding value. Bitcoin is barely 15 years old. That's like comparing a seasoned marathon runner to a toddler who just learned to walk. There's a fundamental difference in proven track record.
Brian makes a valid point about history, but Anna's enthusiasm for Bitcoin's inherent design is also critical. To properly compare, we need to first define what makes something a good store of value. Traditionally, it needs to be durable, scarce, portable, fungible, divisible, verifiable, and generally acceptable. So let's break down how both assets stack up against these criteria.
That's a great framework, Jane. Let's start with scarcity, which is often cited as gold's primary appeal. Brian, what makes gold scarce, and how does that contribute to its value?
Well, gold is scarce because it's finite. It's a precious metal formed over eons deep within the earth. We have to mine it, and that's an incredibly difficult, expensive, and energy-intensive process. There's only so much of it available, and the rate at which we can extract it slows down over time. That inherent limitation, the fact that you can't just print more gold, is what gives it its enduring value.
And Bitcoin takes that scarcity and supercharges it. Instead of geological scarcity, we have mathematical scarcity. Only 21 million Bitcoins will ever exist, ever. It's hard-coded into the protocol, and we know exactly when the supply will reach its cap. You can't say that for gold. New discoveries, new mining techniques, the supply can fluctuate. Bitcoin's scarcity is transparent and absolute.
Anna is right. The predictable, programmatic supply schedule of Bitcoin, coupled with its halving events, creates a deflationary pressure that is quite unique. With gold, while new supply is a small fraction of existing supply, it is still an unknown variable. Bitcoin's supply shock is a known event, making its scarcity arguably more transparent and predictable.
Okay, so scarcity seems like a strong point for both, though perhaps Bitcoin offers a new level of predictability there. Let's move to durability. Gold is, well, gold. It doesn't corrode, it doesn't degrade. It's been found in ancient shipwrecks, still perfectly preserved. How does Bitcoin compare on durability, given it's a digital asset?
That's exactly it, Costas. Gold is physically durable. You can melt it, reform it, bury it, dig it up 1,000 years later, and it's still gold. It's tangible. Bitcoin, being digital, relies on infrastructure. What happens if the internet goes down? What happens if there's a global power outage? That physical resilience of gold is a huge comfort.
But Brian, physical resilience also comes with physical vulnerabilities. Gold can be stolen, it can be confiscated, it can be physically destroyed in a fire or a major disaster. Bitcoin's durability comes from its decentralized network. It exists on thousands of computers globally. For Bitcoin to die, the entire internet would have to go down, and stay down, indefinitely. And even then, your private keys could still be restored when the network comes back up. It's a different kind of durability, one that's arguably more robust against localized physical threats.
From a technical standpoint, Anna's explanation of Bitcoin's durability is accurate. Its redundancy across the network means it's incredibly difficult to kill or corrupt. While gold is durable in its physical form, its security often depends on centralized storage, which introduces single points of failure. Bitcoin's security is distributed and cryptographic, offering a different but robust form of durability against loss or censorship.
That makes sense. It's a paradigm shift in how we perceive durability. Next, portability. This is where I think Bitcoin really starts to shine, no pun intended. Brian, how portable is gold really?
Well, traditionally not very. If you own significant amounts of physical gold, you're looking at heavy bars, needing secure storage, armed guards, insurance, all that jazz. If you want to move large wealth across borders, you're talking about incredibly complex logistics, declarations, taxes, and significant risk. Smaller amounts like jewelry are easier, but we're talking about a store of value here, not everyday trinkets. It's definitely a drawback.
Exactly. Imagine trying to flee a country with $1 million in gold versus $1 million in Bitcoin. With Bitcoin, you literally memorize a few words or carry a small hardware wallet, and you can cross any border with your entire fortune. In minutes, you can send it anywhere in the world, with minimal fees compared to traditional banking or shipping gold. It's unparalleled portability, especially in a globalized, digital world.
The contrast in portability is stark. Gold, in its physical form, is inherently cumbersome and expensive to transport and secure for significant values. Bitcoin, being entirely digital, is essentially weightless and can be transmitted globally almost instantly. This aspect is particularly appealing in an increasingly interconnected and, at times, volatile world where rapid, secure asset transfer is crucial.
Portability definitely goes to Bitcoin then. How about divisibility? Gold can be melted down, but you start losing value with tiny pieces. Anna, Bitcoin's divisibility is pretty legendary, right?
Oh, absolutely. Bitcoin is divisible down to 8 decimal places, meaning you can own a fraction of a Bitcoin, called a Satoshi. That's 0.00000001 BTC. You can literally transact in cents or even smaller units if you want. Try doing that with gold. You can't chip off a microscopic piece of a gold bar and expect it to hold its proportionate value or be easily verified. Bitcoin's divisibility makes it incredibly flexible for everything from micropayments to storing vast wealth.
I mean, yes, technically you can divide gold into smaller physical pieces, but it's impractical. You'd lose material, it would require specialized equipment, and then verifying the purity of each tiny piece would be a nightmare. So, on a practical level, Bitcoin wins hands down for divisibility. I'll concede that one.
Brian's concession is well-founded. Gold's divisibility is limited by its physical nature, leading to impracticality and potential loss of value or increased transaction costs. Bitcoin's digital nature allows for seamless, precise division into extremely small units, which enhances its utility as a medium of exchange as well as a store of value for diverse financial needs.
Alright, so Bitcoin's looking strong on a few fronts there. Let's talk fungibility. This means each unit is interchangeable and identical. A gram of pure gold is a gram of pure gold, no matter where it came from. How does Bitcoin stack up here?
Fungibility is a cornerstone for any true store of value. With gold, if you have an ounce of 24-karat gold, it's interchangeable with any other ounce of 24-karat gold. You don't care where it was mined or who owned it before you as long as it's pure. It's universally recognized and valued because of this. This is where gold's long history provides a clear advantage in universal acceptance.
Bitcoin is absolutely fungible. One Bitcoin is exactly like any other Bitcoin. The blockchain ensures that each unit is a legitimate entry, and the protocol doesn't care about its history on the network. While there are sometimes discussions around tainted coins due to illicit activity, technically, every Bitcoin is identical and can be transacted. The underlying technology guarantees its fungibility at the protocol level, making it even more robust than physical assets that can be damaged or marked.
Anna is largely correct. At the base layer, Bitcoin units are fungible. The slight caveat is the transparency of the blockchain, which can allow for tracing of specific UTXOs. While this doesn't inherently make them non-fungible in the traditional sense, it introduces a layer of scrutiny that doesn't exist with pure physical gold. However, for the vast majority of users and transactions, Bitcoin functions as a highly fungible asset.
Interesting distinction there, Jane. Now, verifiability. With gold, you might need an assay test or a trusted jeweler. How do you verify Bitcoin?
That's one of Bitcoin's superpowers. You don't need a jeweler or a chemical test. Verification is built in. Every Bitcoin transaction is recorded on an immutable public ledger, the blockchain. Anyone, anywhere can verify the authenticity of a Bitcoin and its ownership with cryptographic proof, using publicly available software. There's no trust needed, only math. You can instantly confirm that a Bitcoin is real and hasn't been double spent.
It's true that verifying gold can be a pain, especially for larger transactions. You really need to trust the source or invest in professional testing. The concept of cryptographic proof for Bitcoin is definitely a leap forward in terms of ease and certainty of verification. I can see the appeal there, especially in reducing counterparty risk.
The verifiability of Bitcoin through its decentralized ledger is a significant advantage. It eliminates the need for intermediaries or specialized tools to confirm authenticity and ownership. This enhances trust and efficiency in transactions, a clear benefit over physical assets that require external validation.
Okay, so Bitcoin is performing remarkably well on these technical attributes. But now we come to the big one, acceptability and established history. Brian, gold has literally millennia of human consensus behind it. Central banks hold it, nations trade with it, cultures revere it. How does Bitcoin even begin to compare there?
And that's precisely the point, Costas. Gold's track record is not just about time, it's about universal, global, cross-cultural acceptance as a medium of wealth preservation. It's survived wars, economic collapses, empires rising and falling. Central banks still hold massive gold reserves as a hedge against fiat currency instability. This isn't just about history, it's about deep-seated trust and a proven role in the global financial system. Bitcoin, while growing, doesn't have that institutional backing or centuries of social proof.
I agree that gold has a long history, but that's also its baggage. It's a legacy system. The world is evolving. We're seeing nations adopt Bitcoin as legal tender, major institutions adding it to their balance sheets, and mainstream financial products emerging. The adoption curve for Bitcoin is steeper and faster than anything we've ever seen. The history for Bitcoin is being written now, and it's happening at light speed. It's about future relevance, not just past performance.
The acceptability factor is definitely a major differentiator. Gold has an intrinsic and perceived value solidified over millennia, making it a safe haven asset in times of crisis. Bitcoin, while rapidly gaining acceptance, is still subject to significant regulatory uncertainty and is not yet universally understood or trusted by the broader global population. Its institutional adoption is accelerating, but it's still in its nascent stages compared to gold's deeply embedded role.
That leads us nicely into volatility. Brian, gold is generally considered a stable asset, whereas Bitcoin is notorious for its price swings. Isn't that a huge hurdle for it to be a reliable store of value?
Absolutely, Costas. Volatility is antithetical to a good store of value. The whole point is to preserve purchasing power, not ride a roller coaster. Gold moves, yes, but its movements are typically much more measured. Bitcoin can drop 20%, 30%, even 50% in a matter of weeks or months. How can you reliably store your wealth in something that fluctuates so wildly? That's speculative, not preserving.
That volatility argument, while true for now, often misses the bigger picture. Bitcoin is still a relatively young asset, and it's undergoing price discovery. As adoption increases, as the market matures, and as more institutional money flows in, that volatility is actually decreasing over time, if you look at longer time horizons. Early-stage assets are always more volatile. Also, consider the long-term appreciation against inflation. Gold barely keeps pace sometimes, but Bitcoin, despite its dips, has consistently outperformed everything over the last decade.
Both perspectives have merit. The high volatility of Bitcoin is undoubtedly a concern for those seeking stable wealth preservation, making it less suitable for short-term store of value purposes. However, Anna highlights an important point about market maturity. As the market capitalization grows and liquidity deepens, Bitcoin's volatility is expected to stabilize. For long-term horizons, its historical performance as an inflation hedge and growth asset is compelling, but the risk profile remains significantly higher than gold's.
So it seems like a trade-off between established stability and future potential with higher risk. Finally, let's touch on the idea of an inflation hedge. Both are often touted as such. Brian, how effective is gold against inflation?
Gold has historically been a reliable hedge against inflation. When fiat currencies lose purchasing power, people often flock to gold as a safe haven. It's a tangible asset that can't be devalued by government printing presses. While it doesn't always perfectly track inflation month to month, over longer periods it generally maintains purchasing power. It's a fundamental part of a diversified portfolio specifically for this reason.
And Bitcoin is a superior inflation hedge, in my opinion, because of its fixed, unalterable supply cap. Central banks can't print more Bitcoin. It's completely outside the control of any government or financial institution. In an era of unprecedented money printing, Bitcoin's absolute scarcity makes it the ultimate counterasset to fiat currency debasement. It's digital gold, but with a hard cap that gold can't truly match.
Bitcoin's programmatic scarcity does position it as an excellent theoretical hedge against inflation. Its performance during recent inflationary periods supports this. However, gold's long-term track record gives it a psychological edge for many investors. The key difference lies in the source of scarcity: natural geological limits for gold versus algorithmic limits for Bitcoin. Both offer protection against currency debasement, but Bitcoin's mechanism is arguably more transparent and absolute.
This has been an incredibly insightful discussion. It feels like we're not just comparing two assets, but two different philosophies of wealth preservation. Brian, after this deep dive, do you see Bitcoin ever fully replacing gold as the go-to store of value?
Look, I'm not going to say never. Technology changes everything, but I don't think it'll replace gold in my lifetime. Gold's role is too deeply ingrained, its tangible nature too comforting for many. I think they can coexist. Gold for the traditionalists, Bitcoin for the digital natives. Perhaps Bitcoin becomes a digital gold for a new era, while physical gold remains a bedrock for older generations and established institutions. But replacing it entirely, I'm highly skeptical.
I respectfully disagree with Brian there. I think it's inevitable. Younger generations are less attached to physical assets, they live digitally. Bitcoin offers superior attributes for a digital world: superior portability, divisibility, verifiability. The only thing gold has over Bitcoin is inertia and tradition. Once enough people understand Bitcoin, the transition will accelerate. It might not be tomorrow, but the trend is clear. Bitcoin is the future of sound money.
The most probable scenario, at least in the medium term, is a growing diversification where both assets play a role. Gold will likely retain its status as a foundational safe haven due to its historical precedence and tangible nature. Bitcoin, with its unique digital properties, is carving out its own niche as a modern, digitally native store of value. Investors will increasingly allocate to both, viewing them as complementary rather than strictly competitive, each serving slightly different risk profiles and philosophical preferences.
A fascinating conclusion, Jane. It sounds like the store of value landscape is becoming more nuanced, offering different options for different needs. Thank you all for breaking down such a complex and vital topic with such clarity. It's clear that while gold has its undisputed legacy, Bitcoin is a powerful contender with unique advantages for the digital age. What a time to be alive, watching this evolution unfold. That's all the time we have for today on Value Vault. Be sure to subscribe and tune in next time for more insights. Until then, stay curious and invest wisely.